Hello. I'd like to distinguish between financial versus managerial accounting, two major categories of accounting information. As we just mentioned, financial accounting seeks to provide information to current or future providers of capital, primarily investors or creditors. In addition, this information is also used for other potential parties outside of management. For example, government regulatory bodies are also interested in the same kind of information that's typically made available to investors and creditors. They want to get a big picture of what the business is doing for regulatory purposes. What we're talking about is information to investors, creditors, government, people or institutions that are outside of the daily management of the business. They're not involved in the day-to-day operations. They're really kind of viewing the business not so in a more passive way. They're not involved in actual management, but they have a real interest investment in the business, but they're not trying to get information that allows them to do daily management. We would say that these users of information are really external to the operations of the business. Now, the information that these external users, investors, creditors, government regulatory bodies need, the providing of the information is accomplished primarily through what we call periodic general purpose financial statements. These financial statements are designed to provide basically summarized information that's usually historical, that is information relative to what's happened, just in the recent past or recent year, and what the status of that business is in terms of their financial position, currently. Generally speaking, financial accounting really doesn't deal with projections relative to the future, and the reason for that we'll discuss in a little bit. We are going to be focusing in this class, at least for the first 2/3 of this class, on financial accounting, on these general purpose financial statements that are required to be provided to investors and creditors or the government, that provides them with kind of an overall view of where the business is and where it's come from. Now, this 2/3 of the class is a little more than half the class. Clearly, 2/3 is more than 1/2. Even though we're going to be focusing on managerial accounting in that part of the process, we're also going to be discussing a lot of terminology that's appropriate in terms of general business that will also have application in the area that we're going to discuss as describe as managerial accounting. Managerial accounting is what we're going to be discussing really over the last third of this class. And managerial accounting seeks to provide information not to external users, but to those who are internal to the business, to assist managers in the effective operation of the business. Now, this is typically accomplished not through some periodic summarized reports. This is accomplished primarily through very, very timely, sometimes day-to-day customized management reports that tend to be a lot more detailed in nature and in many cases may include a lot of budgetary forecasted information as well as historical data. These managerial reports, this information that management uses on a day-to-day basis to better operate the business, are not generally available to the public or external users, and really are primarily designed to improve management's future performance. Again, we'll be discussing managerial accounting and how we can create information that's useful to managers in the last third of this class. But for now, we're going to kind of push managerial accounting to the side and really focus on the accounting designed to provide information primarily to providers of capital, investors and creditors, which is also used by government regulatory bodies also. Financial accounting's focus is the general purpose financial statements. There are three general purpose financial statements. One is a balance sheet, or sometimes referred to as a statement of financial position. The second one is referred to as an income statement, or sometimes a statement of operations, or statement of profits and losses. The third required general purpose financial statement is a statement of cash flows, which simply identifies the inflows, major inflows, and outflows of cash. These financial statements can be found in a company's annual report. Now, in these financial statements, there are two critical conditions that must exist for those financial statements to ultimately prove to be truly useful to investors and creditors. One critical element or condition that needs to exist is that they must be comparable. And secondly, they need to be credible. Let me describe what I mean here. In terms of comparability, what I'm talking about here is that comparability really refers to the need for companies to prepare and present their financial statements in the same basic way, utilizing the same basic formats for presentation and the same basic accounting methodologies as other companies. The reason for this is that investors and creditors are faced with choices. It's not just a decision as to whether or not they're going to provide a loan or capital contribution as an owner to your business, but they have other options. A banker might have a loan application not only from your business, but from a variety of different businesses. And so really the investment and credit-making decision is really typically a choice between investment or credit alternatives. And therefore, they're going to be looking at information not just from your business, but from other businesses also. And they want to make comparative analysis. When they do that, they'd like to get a set of financial statements or financial information in the form of statements that basically look about the same. I mean, they want to get a set of some financial information, and both of those documents have a balance sheet and an income statement so that they can compare the balance sheet and the income statement. And they'd like that information to be formatted in some kind of a consistent way so it's easy to compare. In addition to that, it's critical that the methods of accounting for a business's transactions be basically consistent or the same as the way other businesses account for their transactions. I mean, let me give you an example for just how important something like that might be. Let's assume that a banker is looking at some financial statements from two different companies and he's trying to decide to whom he will make a loan for $1 million. Both of the companies have requested $1 million to capitalize the business or to allow it to grow more rapidly. And the banker's trying to decide, gee, which is the better loan? Which is the safer loan? Which of these two companies has the greater capacity to repay us? Or in the event that there's some failure, they have more in terms of resources that we can access for repayment of our loan. And so that's the kind of thought process going on in the mind of a potential creditor. And as they get financial information on both of these applications for the loan, they're looking at the balance sheet. And the balance sheet will list the resources of the business, and he's looking at that, and he discovers that they're almost basically identical, except relative to certain land and buildings. Now, I'm going to make an assumption here that the banker is not aware of. Let's assume that, in fact, the land and the buildings on these two different companies on their balance sheet under resources here, that, in fact, the land and the buildings are basically identical. In fact, they were purchased about the same time by each of these businesses operating independently, but they paid basically the same amount. Let's assume that they paid, $500,000 for the land and the building. And basically, if you went up and looked at the buildings and the land, they almost look identical. And they're in basically, a common type of location. And they paid basically 5 years ago about the same price. And so theoretically, and let's assume that even today, you'd expect that they'd be worth about the same amount. you would expect that, in fact, on the financial statements, that this land and building should be reflected as one of the resources of each of the businesses, and that they ought to be valued about the same way. But let's assume for a moment that one of these businesses has actually gone out and gotten appraisal. Maybe they haven't even gotten appraisal. They just, in their gut, have a feeling that, in fact, this land and the building is really worth much more. It's almost doubled in value in the last 5 years, or at least that's their belief, that's their opinion. And so they decide to reflect the building on their financial statements provided to the banker at a value of $900,000. The other business, however, is, they're not, the business may be worth $900,000, in fact, but they've taken a more conservative approach in terms of valuing their assets. They're not really sure how much the asset is, and they believe that, in fact, they should reflect, instead of maybe its current fair market value, they reflected at $500,000, the amount that they originally paid 5 years ago. They don't have any current appraisal, and so they're taking a more conservative approach. Now, maybe you'd say, wow, that's stupid. They ought to be as aggressive as they possibly can be in terms of valuing that business, in terms of trying to impress this banker to make them a loan. But they're just more conservative in character, and they put $500,000. It may have been an unwise decision, because now the banker, looking at these financial statements, they assume that, in fact, these are two very different businesses now. They're not exactly the same. This one has land and building that's clearly worth much more than this other company. Now, the fact of the matter is the banker should be entirely indifferent if, in fact, the businesses are virtually the same, even the land and building. But the banker is relying on information that has been provided that's really a different technique of accounting for a particular kind of resource. They're not using the same methodology or approach. And so, in fact, the valuations are very different, and ultimately the banker is relying on information that truly isn't comparable in making this decision. If, in fact, you are comparing businesses, but they haven't been prepared comparably, the information of those businesses, that information is basically worthless. And maybe at worst, it might even be deceptive, so that you're actually making, not only not making a decision, but making really poor decisions based on information simply because it's not comparable.